9.33 USD. That is the number flashing on your screen right now, up 97 cents, a staggering 11.60% move to the upside in just a single trading session. If you are watching the ticker tape on your Fidelity mobile app or checking your Robinhood stock trading dashboard, you are probably seeing Vor Biopharma, ticker VOR, lighting up the top gainers list and wondering if this is just another flash-in-the-pan biotech spike or something sustainable. The expectation most retail traders have when they see a small-cap biotech stock jump double digits on a Tuesday is almost always the same. It's a pump, a rumor, or a dead cat bounce that will fade by lunchtime. We have been conditioned by the market to view these moves with extreme skepticism, especially in a sector that has been beaten down relentlessly over the last few years. You assume it is just noise. You assume the smart money is selling into this strength. But the reality, the actual underlying mechanics driving this price action right now is significantly more complex and arguably much more bullish than the casual observer realizes. What we are seeing today is not just a volatility spike. It is a fundamental repricing of risk based on a structural shift in the company's identity. The market is finally waking up to the fact that Vor Biopharma is no longer just an early-stage science experiment focused solely on leukemia. It is rapidly evolving into a late-stage commercial contender with a diversified asset base that includes a massive autoimmune kicker. The gap between that outdated perception and this new reality is exactly where the profit potential lies, and that is what we are going to break down today. Let's look at the immediate price action, because the way this stock is trading today tells a story all on its own. Opening at $8.17 and ripping through resistance levels to hit a high of $9.33 implies aggressive accumulation. This isn't just retail traders chasing momentum on SoFi stocks or tossing a few bucks into a Robinhood cash management account. The volume profile suggests institutional commitment. When you see a stock hold its gains into the afternoon session rather than fading, it typically indicates that the buyers are not looking for a quick scalp. They are positioning for a longer time frame. We are seeing volume spikes that are 3 to 4 times the average daily turnover. If you track flows through interactive brokers trading platforms, you will often see that this kind of accumulation pattern precedes a major repricing event, usually because a large fund or a series of funds have decided the stock is mispriced relative to its peers. The tension here is palpable. You have the old guard of investors who remember Vor as a single asset story, struggling with cash burn, and they are likely selling today, happy to get out at break-even or a small loss. On the other side, you have new capital entering the fray, investors who are looking at the Q3 2025 data, the new partnership dynamics, and the autoimmune pivot, and seeing a stock that could be trading at multiples of its current price if execution holds up. That friction between the sellers of the past and the buyers of the future is what creates this volatility, and right now, the buyers are winning. But before we get too far ahead of ourselves, I want to pause and ask you a question about your own positioning. Comment below how many shares of Vor Biopharma you currently hold, or if you are sitting on the sidelines waiting for a pullback. It is always fascinating to see where the sentiment is among actual individual investors versus what the analysts are saying. Now, to understand why this 11.60% move matters, you have to look at the broader context of how people handle online investing in the biotech sector. Most people using Schwab Intelligent Portfolios or similar automated tools are underweight in this sector because it is high risk, it is volatile, it scares people. So when a company like Vor starts to outperform, it forces active managers and those engaging in self-investing to take a hard look. They have to ask, did I miss something? In Vor's case, what the market missed was the strategic brilliance of their recent licensing deals. For the longest time, Vor Biopharma was known for one thing: Vor shielded transplants. The concept is scientifically elegant. You have patients with acute myeloid leukemia. You want to treat them with powerful targeted therapies that kill cancer cells expressing a certain protein, usually CD33. The problem is, your healthy bone marrow cells also express CD33. So if you hit the patient with the drug, you wipe out their immune system and their blood-making capability. It's a biological catch-22. Vor's solution, their flagship technology, was to gene-edit the healthy donor stem cells to remove that CD33 target. By doing this, they create a shielded blood system. The patient gets the transplant, the new healthy cells have no CD33, and then the doctors can blast the patient with high-dose CD33 targeted therapies, like Mylotarg or CAR T cells, to kill the cancer without touching the healthy blood cells. It's a brilliant lock-and-key approach that could fundamentally change how we treat liquid tumors. That was the expectation: a cool science project, high risk, long timeline. The reality that is hitting the tape today, however, is that Vor has effectively hedged that scientific risk by pivoting hard into autoimmune diseases. Late in 2025, a narrative shifted. The company isn't just betting the farm on AML anymore. They have brought in assets like telitacept, which has shown incredible promise in late-stage trials for things like lupus, SLE, and Sjogren's disease. This is a massive market. We're not talking about a niche orphan disease anymore. We're talking about indications with millions of patients where the current standard of care is often steroids or broad immunosuppressants with terrible side effects. When you look at the data coming out of China for telitacept, specifically the Phase 3 results showing statistically significant improvements in disease activity for lupus patients, you realize this is a de-risked asset. It works. The mechanism of action, inhibiting BLYS and APRIL, two proteins crucial for B-cell survival, is sound. By licensing this and bringing it into their pipeline, Vor transformed from a binary event biotech stock, where you either win big or go to zero based on one trial, to a diversified platform company. That is what the 11.60% move today represents. It is the market assigning value to that diversification. For an investor using a platform like Fidelity Investments to research this, it might look like a sudden jump, but the breadcrumbs have been there. The smart money, the folks using Interactive Brokers stock trading terminals with deep algorithmic access, started sniffing this out months ago. They saw the pivot coming. They saw the executive leadership changes, with new blood coming in to steer the commercial strategy. They saw the cash runway extension. Today's price action is the retail market and the broader funds finally catching up to that reality. Let's talk about the mechanics of the trade itself. At 9.33, Vor is breaking out of a consolidation range that has held it back for weeks. Technically, this is a blue sky setup if it can close above the $9.50 resistance level. We are seeing a lot of activity in the options market as well, which often acts as a precursor to sustained equity moves. When traders on Robinhood Investments or SoFi Investing start buying calls, it forces market makers to hedge by buying the underlying stock, creating a feedback loop that pushes the price higher. This gamma squeeze mechanism is likely contributing to the sharpness of today's move. It is also worth noting the macro environment. We are in a period where interest rates have stabilized and risk appetite is returning to the biotech sector. For a long time, high rates crushed these stocks because their future cash flows were discounted heavily. Now, with a clearer path to profitability, or at least a clearer path to commercial revenue via the autoimmune portfolio, Vor looks much more attractive to the Fidelity wealth management types who focus on long-term growth at a reasonable price. However, we must remain grounded. The smart friend advice here is to look at the risks just as closely as the rewards. Biotech is notoriously fickle. While the move to 9.33 is fantastic for current holders, the company still burns cash. Developing drugs, running phase 3 trials in the US, and preparing for commercialization is incredibly expensive. You have to watch the balance sheet. Investors utilizing detailed research tools on Fidelity brokerage accounts should be looking at the cash runway. Does the company have enough money to get to the next major data readout without diluting shareholders again? The recent financing rounds were helpful, but in this industry, capital is oxygen. If they run low, they will issue more stock, and that 9.33 price could come under pressure. Furthermore, the integration of a new asset class, moving from pure oncology to autoimmune, is not without execution risk. Can the team that was built for leukemia